Imagine a world where a single ounce of gold costs nearly $5,000, and like a single ton of copper is over $13,000.
Yeah, that's a massive premium.
Right. But according to this highly detailed April 2026 financial report by Goldman Sachs, that isn't science fiction. I mean, that's the immediate future. So welcome to the deep dive.
Glad to be here diving into this with you.
We spend, so much time obsessing over the digital economy, AI, cloud architecture, software as a service, but we forget that the cloud is, well, it's heavy.
Extremely heavy. I mean, you literally cannot build a billion-dollar AI data center without miles and miles of copper wiring.
Exactly. You can't make a smartphone without gold. You aren't building tomorrow's infrastructure without iron ore. And you definitely aren't shipping a single package without pulp and paper.
And Latin America is essentially the resource engine room for that global economy. It's where a huge percentage of the world's copper, iron, and pulp comes from. Without it, the tech sector it grinds to a sudden halt.
Right. And today, our mission for this deep dive is to extract the real signal from the noise of this massive Goldman Sachs coverage on Latin American metals, mining, and pulp and paper.
There's a lot of noise in there, too. Stacks of data tables, sensitivity analyses.
Oh, yeah. So much data.
Yeah.
But we're going to uncover exactly how massive financial institutions decide which of these companies are primed to explode in value and which ones are ticking time bombs. So, okay, let's unpack this. Before we get lost in the spreadsheets, we need to see the scoreboard. Who is Goldman Sachs actually betting on here, and who are they betting against?
Well, an equity research report of this magnitude has to, draw a firm line in the sand.
Right.
It tells institutional investors where to deploy billions of dollars. So the dividing line is incredibly sharp. On the buy side, you have some absolute heavyweights. Vale, which is a titan in iron ore.
Yep.
Suzano in the pulp industry. And then Aura Minerals, ticker AUGO, pulling gold out of the ground. And Grupo Mexico for copper.
So those are the golden children, the ones they want you allocating capital to, but on the other side of the ledger.
The sells are where Goldman is throwing up serious red flags. They're explicitly warning investors away from CSN and CSN Mineración, that's CMIN, both in steel and iron ore.
Oh, wow.
Yeah. And they also slapped a sell rating on Copec, which is a conglomerate in pulp, forestry, and fuel.
Okay, looking at this list, I really want to frame this for you listening, because investing in these capital-intensive industries down in Latin America, it feels a lot like trying to navigate a massive, unpredictable river.
That's a good way to put it.
Right. Like, you can have the best boat, the smartest management team, but if you don't know exactly where the underlying currents are taking you, you're going to crash. And here, those currents are global commodity prices. But I have to push back a bit. I'm a little confused. Why are we analyzing copper mines and paper mills in the exact same deep dive? What connects them? I mean, digging iron ore is fundamentally different than harvesting eucalyptus trees, right?
It's a super common point of confusion. The connection isn't the physical product at all. It's the shared economic reality. Both mining and pulp and paper are deeply cyclical resource extraction businesses.
Okay.
They're hypersensitive to global macroeconomics. If China's property sector slows down, less steel is made, fewer boxes are shipped, and demand for both iron ore and pulp drops at the exact same time. But more importantly, they are entirely dependent on spot prices.
Meaning they don't get to set the price of their goods like, say, a normal consumer brand would.
Correct. Apple decides what an iPhone costs, adds a margin, and sets the price. A company like Vale, they don't decide what a ton of iron ore sells for. They sell into a live, fluctuating global spot market. The market dictates the price, and Vale just has to accept it.
Man, that's brutal.
It is. Plus, both require massive capital expenditure, billions of dollars just to build a mine or a mill.
So the fixed costs are astronomical. And those global spot prices, the currents of our river, that's exactly where Goldman starts their math. To understand the buy or sell list, we have to look at the 3 critical data points anchoring this 2026 report.
Right. And the first data point is that macroeconomic baseline, the sizzling spot prices. For April 2026, they are anchoring copper at a massive $13,301 per ton.
Insane.
Gold at $4,710 an ounce, and iron ore at $108 a ton. Every single financial projection flows downhill from those numbers.
But the second data point is how that spot price translates into actual business health, free cash flow yields, or FCF yield. Let's contrast a winner and a loser here. Look at Suzano, the pulp giant on the buy list. Goldman estimates an 8.3% free cash flow yield for 2026.
Which is very healthy. That's real cash left over after paying workers and keeping the lights on.
Exactly. But then look at CSN, which is on the sell list. They're facing a massive negative 58.8% FCF yield.
Yeah, a negative FCF yield approaching 60% is, well, it's a five-alarm fire. They are consuming cash at an alarming rate just to service their debt.
I want to make this visceral. Having a negative 58% FCF yield is like trying to run a marathon while actively bleeding out. It doesn't matter how fast you are, you're not going to finish the race.
What's fascinating here is how that cash flow reality bleeds directly into the third crucial data point, which is the EV to EBITDA multiples.
Well, Wall Street loves that acronym. Let's break it down. EBITDA is basically raw earning power before accountants and taxes.
Right. Pure operational profitability.
Yeah.
And EV, or enterprise value, is the total price tag of the company, including all its debt. So the multiple tells us how many years of raw earnings it takes to pay for the whole company.
Okay.
When a company generates strong free cash flow, like Aura Minerals, they trade at a very favorable 6.3 times EV to EBITDA for 2026.
So roughly 6 years to pay off the valuation. That shows value.
Exactly. But a company bleeding cash like CSN, the debt load gets so heavy the multiple blows out and the stock looks incredibly expensive despite its struggles.
So we know Suzano and Aura are printing cash, while CSN is hemorrhaging it. But why do these numbers flip so violently? Having seen the cash flow data, we have to explore why these numbers are so extreme. What is the core driver behind these valuations?
Operational leverage. We mentioned those massive fixed costs earlier. Because those don't change whether you mine 1 ton of copper or 1 million, the profit margins are incredibly sensitive to tiny changes in spot prices. Goldman illustrates this with a plus or minus 10% sensitivity analysis.
Here's where it gets really interesting. Let's look at CSN, Minerasen, CMIN. If iron ore prices drop just 10%, which is honestly a normal Tuesday in commodities.
Barely a breeze.
Right. CMIN's EV to EBITDA spikes to a bloated 12.3 times, and their FCF yield plummets to nearly negative 19%. A tiny shift creates a tidal wave on their balance sheet.
But it works both ways. If copper jumps 10%, Ero Copper's FCF yield rockets past 13%. These companies are essentially massive leveraged bets on the underlying commodities.
Okay, let's say it costs $80 in fixed costs to mine a ton of ore, and the spot price is $100. You make $20 profit.
Right.
If the spot price goes up 10% to $110, your fixed costs are still $80, but your profit jumps to $30. That's a 50% increase in profit from a 10% price bump.
And if it drops 10% to $90, your profit gets cut in half.
So buying a mining stock is literally buying a hyper-leveraged lottery ticket on the global spot price. If it's all just math based on commodity prices, does everyone on Wall Street agree?
Absolutely not. And that brings us to the core risk, the massive gap between Goldman Sachs and the rest of the market, the GS versus consensus data.
Yeah, let's look at Suzano. Goldman rates it a buy, but they are modeling Suzano's 2026 revenue at about 12% lower than market consensus and 21% lower for 2027.
And for CMIN, they expect an EBITDA of around 3,900 million BRL, which is 31% lower than the street expects.
Wait, I have to push back here. If Goldman thinks Suzano is going to make 12 to 21% less money than everyone else thinks, isn't that a massive red flag? Why on earth is it still on the buy list?
This raises an important question. It's about a margin of safety. Goldman is modeling a pessimistic reality, maybe fears of oversupply. But because Suzano's eucalyptus plantations grow so fast, they have incredibly low cash costs. Even with ultra-conservative estimates, Suzano's underlying valuation and FCF generation remains so strong that it's a buy regardless. They can afford for things to go wrong.
Whereas CSN Minerason doesn't have that margin of safety.
Exactly. When you apply realistic estimates to CMIN, they're leverage balloons and the thesis just disintegrates.
Okay, so we've covered the data, the drivers, and the risks. Now, how does a listener actually synthesize this? How do you build a mental model for investing?
Well, the report provides a matrix of FCF yield versus production growth. You want the top right quadrant, high growth, high FCF.
So what does this all mean? Who's in that quadrant?
Aura Minerals and Ero Copper. They are comfortably in that sweet spot, growing production without burning all their cash.
And the bottom left is the basement. Low growth, low FCF.
Right. That's where CSNA3, or CSN, is languishing. If we connect this to the bigger picture, evaluating capital-intensive businesses always comes down to this matrix. Can you grow production without burning all your cash?
So to summarize the value for you listening, whether you're looking at mining giants or tech startups, understanding the leverage between raw inputs like spot prices and free cash flow is the ultimate shortcut to knowing a business's health.
Absolutely.
But I want to leave you with one final provocative thought. The report prices gold at a staggering $4,710 and copper over $13,000 in April 2026. If we're entering an era of resource scarcity or massive infrastructure demands for AI and electrification, could even these optimistic spot scenarios eventually look far too conservative?
It's a great point. What happens if the baseline simply shifts forever?
Exactly. If that river rises permanently, those top-right companies become the cornerstones of the new economy. Well, I want to invite viewers to subscribe to this channel. Next episode will be even more exciting. This video is for research and analysis purposes only and does not constitute any investment advice.